Untitled Cap. Today's video will be about straddles. It's an option strategy. Buying versus selling. Which one should you do? A lot of people get confused with the buying and selling part. If you buy an option, that means you're picking a direction, right? If you buy calls, you want the stock to go up. If you want to buy puts, you want the stock to go down. But you could take the other side of the trade. You can actually sell those options. So when you sell it, it's the opposite. If you sell a put, you want the stock to go up. If you sell a call, you want the stock to go down. I'm not talking, when I say selling, I don't mean, oh, you buy something and you sell it afterward. Selling could be the original trade idea and not the after you buy it. So you could sell something without owning it. So basically, a straddle is a neutral position where you profit on large moves. So the setup is you buy a call, you buy a put, same strike, same expiration. So it looks something like this. Your P&L, your profit, would be after a large move. This is for like earnings plays or right before some big announcement. If you believe the stock's going to move far, has high implied volatility, a lot of people are expecting it to move a lot, straddles are for you. And nobody ever knows which direction it's going to move. If you know there's going to be a big move, straddles are safer than just trying to pick a direction. If you want to go directional and say, okay, I want to buy a call, you could be wrong. If you say, okay, I want to go downside, everybody's too bullish, I want to buy a put, you could be wrong. As long as the stock moves crazy, you'll profit on a straddle. If you buy both directions, so goes up on a put, goes up on a call, let's say this is the call, let's say this is the put. Let's say before you bought it, it was $50. After the move, it was $80, right? So you'll make money on the call, but the put will lose a lot of money. Well, not a lot of money, because there's only so much an option can go down. It can go to zero. So you need the move strong enough. The call will make you enough money to overshadow the loss on the put. So buy a straddle, you buy a call, you buy a put, same strike, same expiration. You need the stock to move a lot to offset the loss on the other side. You also may hear a strangle, which is similar to the straddle, but the only difference is a different strike price. A strangle is for when you want to lean it more towards a certain direction. Let's say you don't know which way a stock's going to move, but you're a little bit more bullish than you are bearish. You could change the strike to, profit a little bit more in that direction. Now you sell a straddle. Sell call, sell put, same strike, same expiration date. Now this is a little different. A straddle, you want, the stock to move crazy high in either direction, but you just want it to move a lot, because if it doesn't move a lot and it stays flat, you're going to lose money on both sides. If a straddle looks like this, where your profits are on the greater moves, selling a straddle is the opposite. You actually want it to stay flat. You want it to stay in this range. You don't want it to go crazy far. You want the move to not be as strong as what the market was implying. This can work also on earnings plays, because a lot of time the markets overestimate what the stock's going to do. And if they overestimate, if their implied move is not as strong as their realized move, if it's lower than the actual move that happens, then the options won't be worth as much. Say you bought Boeing, you bought one $4 call, one $4 put, same strike, a 150 strike. Because Boeing had a crazy move, the put wouldn't be worth as much, but the call would go up. On Friday, let's say the call is worth like $9 and the put's worth like 40 cents. So you lose money on the put, but you make money on the call. So if you sell them both, you'll be in profit. Let's say Roku stayed flat this week, and you sold a call on Monday that was worth $4 with expiration this Friday, and the put was $4 as well. If Roku stayed flat and it didn't move much, then both of these prices would go down, because the move wasn't crazy in either direction. So if it wasn't crazy, then the value of the options would go down. And let's say they're both worth $1 now. You buy those back for $2, and you make 8 minus 2, you make the $6 difference. So you would have made $600 on that. This is fake money, thinkorswim. Let's say we bought Boeing and we bought a straddle. Right click, buy straddle, one call, one put, same strike, same expiration. You paid $9.08, so that's $900. If you fast forward this to Friday, 5,648 you would have got back. That was, you made 6,000 on the call. That went up crazy, and you lost pretty much the whole put. It's only worth 5 cents now, $5. Beautiful. So when you take the profit on the call side and the loss on the put side, that's a $5,658 trade. $900 to $5,658. Good trade. One that I missed. What stayed flat this week? Let's do this one then. Boeing, 518. 518. We'll go back in time for Boeing when it didn't have a crazy move. Let's say we want to do the opposite and we want to sell a straddle. You sell a straddle. 947 is the most you can make when you sell the option. Come on, you scumbag. With this one, you made money since it stayed fairly flat because the implied move was less than the realized move. You wouldn't have made money if you bought the straddle. But since this is flat, since the stock barely moved this week, the week of May 22nd, you profited on both sides, right? You made money on the call because it was originally $4.25, and if you bought it back, it was $3. So you made $112, and originally on Monday it was $5.17 for the put. Today it's worth 22 cents. That's what you want with selling. You want the value of the call or the put to go down. It's like buying back. Like when you short a stock at a higher price, you buy it back when it's lower. So the implied move, either the market expected a larger move from Boeing, or the volatility in the whole market dropped, in which it did because stock's been going up. But overall, when the market goes up, you'll see a drop in volatility. When people start worrying about stocks, they tend to hedge more. They start to buy both sides. They start to go heavy more on puts. Well, let's do this one again and show you the straddle. Let's say you bought it, right? You bought the straddle. You don't just keep winning money. Trade, and you just bought the straddle. You thought the stock was gonna go crazy. You would pay $930 for it, $930. Oof. You would have lost $500 right there. The weekly, 5-day, she didn't really move that much. You know that. Maybe if you bought the straddle right here and then she had a 6% move up, you would have made enough money to the calls than the puts. But anyhow, straddle. If you're buying straddles, you want a large move in either direction to offset the other side. If you're selling a straddle, you want the stock to stay flat. E&J Cat.